You have exactly 24 hours. That's it. After that, this window closes, and what I'm about to show you suggests you'll be paying significantly more, or worse, you won't be able to get physical metal at all. I know that sounds dramatic. But let me walk you through what's happening right now in the gold market that has some of the smartest money managers I know quietly panicking. 3 days ago, the World Gold Council released their Q4 2024 data. Central banks bought 333 tons of gold in the fourth quarter alone. That's the highest quarterly purchase in over a decade. For the full year, official sector buying exceeded 1,000 tons for the third consecutive year, 1,086 tons to be exact. To put that in perspective, that's more than 20% of total global gold demand now coming from central banks. But here's what nobody's talking about: the acceleration. In 2022, central banks bought 1,082 tons. In 2023, they bought 1,037 tons. In 2024, they bought 1,086 tons. The pattern isn't slowing, it's intensifying. And when you dig into who's buying, that's where this gets really interesting. Poland just added another 90 tons to their reserves. Turkey bought 75 tons in the last quarter alone. India's central bank, which already holds over 800 tons, continues accumulating. But the real story is China. Official Chinese gold reserves increased by 225 tons in 2024, according to their reported figures. But analysts at Metals Focus believe the actual number is significantly higher, possibly double that, because China has a history of underreporting their strategic gold purchases. Why does that matter to you in the next 24 hours? Because when central banks buy gold at this pace, they're not doing it for investment returns. They're doing it because they see something coming that they need to protect against. And they're willing to pay premium prices to get physical metal now rather than wait. Let me show you what I mean. Right now, gold is trading around $2,750 per ounce. That's near all-time highs. Most people look at that price and think they've missed the move. But Metals Focus, one of the most respected precious metals research firms in the world, just released their 2025 forecast. They're projecting gold will hit $3,210 per ounce this year. That's a 35% increase from current levels. Think about that for a second. When was the last time you saw a major research firm project a 35% move in a mature asset class like gold? This isn't some crypto speculation or penny stock pump. This is institutional analysts looking at supply, demand, and monetary policy and saying gold is going to $3,210. But here's where your 24-hour window comes in. That forecast assumes you can still get physical metal at spot price. And that assumption is breaking down right now. I was talking to a dealer friend of mine yesterday. Guy who's been in the business for 30 years, moves serious volume. He told me something that made my blood run cold. He said, "The premiums are starting to disconnect." What he means is this. There's the spot price you see on your screen, and then there's the actual price you pay to get a physical gold coin or bar in your hand. That difference, the premium, is normally pretty stable. Maybe 3 to 5% over spot for standard products. Right now, he's seeing premiums of 8–10% on American Gold Eagles. On some European products, it's even higher, and the delivery times are stretching out. Used to be you could get standard products in a week. Now he's quoting 3–4 weeks for certain items, and that's if you order today. This is exactly what happened in March 2020 when COVID hit. Gold spot price was around $1,600. But if you actually wanted to buy a physical coin, you were paying $1,850 or more, if you could find one. The paper price and the physical price completely disconnected. People who waited thinking the price would come down ended up paying more and waiting months for delivery. We're seeing the early stages of that same dynamic right now. And once it really takes hold, your 24-hour window becomes irrelevant because you simply can't get metal at any reasonable price. Let me explain why this is happening. The gold market operates on two levels. There's the paper market, futures contracts, ETFs, certificates, where most of the price discovery happens. Then there's the physical market, actual bars and coins that you can hold. These two markets are supposed to stay connected, but they're linked by a mechanism that's under enormous stress right now. That mechanism is the COMEX warehouse system and the London Bullion Market Association vaults. These are the places where physical gold backs up the paper contracts. And the registered inventory, the gold that's actually available for delivery, has been declining steadily. COMEX registered gold inventories are down 40% from their 2021 peaks. We're talking about roughly 8 million ounces of deliverable gold backing a paper market that trades 10 times that amount every single day. It's like a bank that has $100 million in deposits but only keeps $10 million in the vault because they assume not everyone will want their money at once. That works fine until there's a run on the bank. And right now, we're seeing the early signs of a run on the physical gold market. The evidence is everywhere once you know where to look. Gold ETF holdings increased by 228 tons in Q4 2024 alone. That's institutional money, pension funds, hedge funds, family offices, moving into gold. But here's the kicker. They're not just buying paper ETFs. The premium on physically backed gold ETFs like FUAS has been widening. That tells you sophisticated investors are specifically seeking physical exposure, not just price exposure. Then, you've got the BRICS nations. At their summit last year, they discussed creating a gold-backed trade settlement system. Now, you can debate whether that'll actually happen, but what you can't debate is what they're doing right now. Russia, China, India, Brazil, South Africa, all of them are accumulating gold at unprecedented rates. Russia's central bank holds over 2,300 tons. China's official reserves are over 2,200 tons. And again, that's probably understated. These countries represent 40% of the world's population and a growing share of global GDP. And they're systematically moving away from dollar reserves into gold. That's not a conspiracy theory. That's official central bank data. Now, I want to pause here, because if you're sitting on $100,000 or more in retirement accounts, there's something you should know about. I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. A lot of people don't realize you can do this, but it's a completely legitimate IRS-approved strategy. Worth checking out if that's relevant to your situation. Anyway, back to why you have 24 hours to make a decision. The supply side of this equation is getting worse, not better. Global gold mine production has been essentially flat for the last 5 years, hovering around 3,000 tons annually. The easy gold has been mined. New discoveries are rare. The ore grades are declining. It takes 10-15 years to bring a new mine online. And with environmental regulations tightening, that timeline is getting longer. Meanwhile, demand is exploding. Central banks are buying over 1,000 tons a year. Jewelry demand, particularly from India and China, remains strong at around 2,000 tons annually. Technology uses about 300 tons. And now you're seeing a resurgence in investment demand as people wake up to what's happening with currency debasement. Do the math. You've got roughly 3,000 tons of new supply hitting the market each year. You've got 3,500 plus tons of demand. The difference has to come from somewhere. It comes from existing stockpiles, from recycling, from people selling their gold. But those sources are finite and price sensitive. As the price goes up, some supply comes to market. But central banks don't care about price. They're buying for strategic reasons. They'll pay whatever it takes. This creates a feedback loop. Higher prices bring out some supply but also attract more investment demand. More investment demand tightens physical availability. Tighter physical availability widens premiums. Wider premiums attract more attention. More attention brings more buyers. And round it goes. We saw this exact pattern in 1979-1980. Gold went from $200 to $850 in less than 2 years. Everyone thinks that was just inflation and the Iranian hostage crisis. But if you study what actually happened, it was a physical shortage. The Hunt brothers were trying to corner the silver market, which created spillover demand into gold. Iranian and Middle Eastern money was fleeing into hard assets, and the physical market couldn't keep up with demand. Premiums exploded, delivery times stretched to months, and the price went parabolic. I'm not saying we're going to see gold at $4,000 in the next 6 months, but I am saying the conditions are eerily similar. You've got geopolitical instability, you've got currency concerns, you've got central banks buying aggressively, and you've got a physical market that's showing signs of stress. Here's what concerns me most: the complacency. I talk to regular investors and they see gold at $2,750 and think, hey, it's expensive, I'll wait for a pullback. Meanwhile, central banks are paying up. Institutions are paying up. Smart money is paying premiums to get physical metal now. There's a concept in markets called the most important price. It's not the price you see on the screen. It's the price at which you can actually transact in size. And right now, those two prices are starting to diverge. Let me give you a specific example. Last week, a large European pension fund wanted to buy 50 tons of physical gold. That's about $4 billion worth. They couldn't get it at spot price. They had to pay a premium and accept delivery over several months from multiple sources. This is a sophisticated institutional buyer with relationships and volume discounts, and they still couldn't get immediate delivery at spot. Now imagine what happens when retail investors, millions of people, decide they want physical gold. The system can't handle that kind of demand. The mints can't produce coins fast enough. The refineries can't process bars fast enough. The dealers don't have inventory. And prices gap up violently. This is why your 24-hour window matters. Right now, today, you can still call a reputable dealer and get standard products at reasonable premiums with delivery in a few weeks. That window is closing. Not because I'm trying to scare you, but because the data shows it's closing. Look at what happened with silver in 2021. Silver spot price went from $12 to $30. But if you wanted to buy physical silver eagles, you were paying $40, $45 per coin. The premium was bigger than the entire spot price had been a year earlier. People who waited to buy on a dip never got their dip. They just paid more and more as premiums expanded. Gold is a much bigger, more liquid market than silver. It won't move as violently. But the same dynamics apply. When physical demand overwhelms available supply, premiums expand, and they expand fast. Here's another piece of the puzzle that most people miss: the dollar. Everyone talks about gold in dollar terms, but gold isn't really moving. The dollar is. When you see gold at $2,650, what you're really seeing is the dollar losing purchasing power, and the pace of that loss is accelerating. The U.S. national debt just crossed $36 trillion. That's trillion with a T. The deficit for 2024 was over $1.8 trillion. The interest payments on the debt are now over $1 trillion per year, more than we spend on defense. This is not sustainable. Everyone knows it's not sustainable. But nobody wants to be the politician who cuts spending or raises taxes enough to fix it. So what happens? They keep printing. They keep borrowing. And the dollar keeps losing value. Not in a dramatic crash. That would actually be easier to deal with. But in a slow, steady erosion that most people don't notice until they look back and realize their savings by half of what they used to. Gold is the canary in the coal mine for this process. When gold starts moving up aggressively, it's telling you that smart money sees the currency debasement accelerating. And right now, gold is screaming. But here's what makes this moment different from 2011, the last time gold hit all-time highs. Back then, it was mostly Western investors buying. This time, it's central banks, it's Eastern nations, it's institutions. These are not weak hands that will panic sell on a 10% correction. These are strategic buyers who are in for the long haul. That changes the character of the market. In 2011, gold hit $1,900 and then crashed back to $1,050 over the next 4 years because it was driven by momentum and speculation. This time, there's a floor under the market. Central banks aren't selling. They're buying dips. That creates a very different technical setup. Technical analysts are noticing this. Gold has been in a consolidation pattern between $2,600 and $2,700 for the last few weeks. That's not weakness, that's accumulation. Big players are using this range to build positions. And when it breaks out above $2,700, there's very little resistance until $3,000. But again, that's the paper price. The physical price is already higher if you factor in premiums and delivery delays, and that gap is widening. I want to be clear about something. I'm not telling you to bet the farm on gold. I'm not saying sell everything and buy gold coins. What I'm saying is that if you've been thinking about adding gold to your portfolio, If you've been considering it as insurance against currency debasement or geopolitical risk, now is the time to act. Not next month, not after you see how things develop. Now, because here's what happens if you wait. Best case scenario, gold pulls back 5% and you save a little money on the entry price. But you're still paying elevated premiums and waiting for delivery. Worst case scenario, gold breaks out above $2,800. Premiums spike to 15–20%, and you're paying significantly more for the same metal while waiting months for delivery. The risk-reward is asymmetric. The downside of acting now is small. The downside of waiting could be substantial. Let me tell you about a guy I know. We'll call him Robert. In 2019, Robert was thinking about buying gold. It was around $1,400 an ounce. He thought it was expensive because it had been under $2,300 for years. He decided to wait for a pullback. Then COVID hit. Gold went to $2,600, then $1,800, then $2,000. Robert kept waiting for his pullback. By the time he finally bought in 2020, he paid $1,250 and waited 6 weeks for delivery. If he just bought in 2019 when he first thought about it, he'd have saved $550 per ounce and gotten immediate delivery. Don't be Robert. If you've been thinking about this, if you've been researching it, if you know you want exposure to physical gold, the time to act is now. Here's what I recommend. Call a reputable dealer today, not tomorrow. Today. Ask about current premiums and delivery times. Compare a few dealers, but make a decision within 24 hours. Because every day you wait, those premiums are likely to be higher and those delivery times longer. And be specific about what you want. Don't just say, I want to buy gold. Know whether you want coins or bars. Know what size. Know what products. American Gold Eagles are the most liquid but carry higher premiums. Canadian Maple Leafs are slightly cheaper. Gold bars are the most cost-effective for larger purchases but less liquid for selling later. If you're buying for long-term wealth preservation, I'd lean toward coins. If you're buying in size and plan to hold for decades, bars make sense. But whatever you choose, get physical metal, not paper certificates or unallocated accounts. You want to own the actual gold, not a promise to deliver gold. And here's a critical point. Verify your dealer. There are a lot of scams in this space. Stick with established dealers who've been in business for decades. Check their ratings. Read reviews. Make sure they're authorized dealers for the mints whose products they're selling. Don't chase the lowest price if it means dealing with a sketchy operation. The other thing to think about is storage. If you're buying a few coins, a home safe is fine. If you're buying serious weight, you need to think about professional storage. Some dealers offer segregated storage where your specific bars or coins are held in your name. That's ideal, but more expensive. Allocated storage is cheaper, but your gold is pooled with others. Unallocated storage is cheapest, but you don't own specific metal. You own a claim on metal, which defeats the purpose. My personal preference is segregated storage at a private vault facility, not a bank. Banks have their own risks, and in a real crisis, they could restrict access. Private vaults are specifically designed for precious metals storage and have better security and access policies. But these are details you can figure out. The important thing is making the decision to act within your 24-hour window. Let me paint you a picture of what I think happens over the next 6 to 12 months. Gold continues grinding higher, hitting $2,800, then $3,000. Each time it breaks through a major level, there's a surge of new buying. Premiums on physical metal expand from 8% to 12% to 15%. Delivery times stretch from weeks to months. Some products become completely unavailable at any price. The mainstream media finally catches on around $3,200. CNBC runs segments on the gold rally. Your neighbor mentions he's thinking about buying gold. By that point, you're paying $3,500 for metal that's quoted at $3,200 spot, and you're waiting 3 months for delivery. Or you act today. You pay $2,650 plus an 8% premium, so call it $2,860 all in. You wait 3 weeks for delivery. And 6 months from now, when gold is at $3,200 and premiums are 15%, you're sitting on metal you bought at an effective price of $2,160. That's a 12% gain even if the spot price only goes up 20%. That's the opportunity, but it requires acting now, not later. I know this is a big decision. I know it feels uncomfortable to buy something at all-time highs. Every instinct tells you to wait for a pullback. But sometimes the right move is the uncomfortable move. And right now, all the data, central bank buying, supply constraints, premium expansion, delivery delays, is telling you that waiting is the higher risk choice. Your 24-hour window is ticking. Use it wisely.